When it comes to your retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated just like a number. This is your retirement. So it's time to think differently. And you're in luck because you've found the Retire Your Way podcast with ILG Financial. At ILG Financial, you won't find generic, run-of-the-mill plans containing the same old cookie-cutter solutions. Dave Chase and the ILG Financial team focus on building one retirement at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hats and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now.
Income, legacy, growth. It's all right here at ILG Financial. Welcome to the Retire Your Way podcast. It's all about helping you plan for retirement your way so you can achieve your financial goals. Call ILG Financial at 540-720-5656, or you can go online to ilgfinancial.com to learn more. I'm Ron Stutz, and Dave Lopez is here. Of course, ILG Financial. In today's episode of Retire Your Way with ILG Financial's Dave Lopez, he's going to be covering some economic and market topics in a state-of-the-market discussion. It's going to be really fun today to talk about these things. How are you today, Dave?
I am doing great. It is good to be here. I will tell you, Ron, I have been looking forward to this podcast together, this state of the market, because these are questions that come up all the time when I'm meeting with folks about how these economic and government issues, how we believe they're going to affect them in retirement. So what you're going to hear today is, because we focus on looking after our clients and their retirement, we're going to take a look at these different issues and talk about briefly what they are and what's going on, but then we'll kind of always circle back to how we think that's going to affect the investment markets. Exactly. And then directly or indirectly their retirement planning.
Well, so much is going on right now in the world and so much uncertainty out there. And so I think it's going to be really good to highlight some global events, policy decisions, and emerging technologies that shape our markets and influence client portfolios. So first of all, one thing that I don't know about you, but I'm kind of sick of hearing about all this, tariffs and how they're going to affect the market. Tell us about the impact on the market of all these tariffs that we keep hearing about.
Yeah, that's a great place to start. So just a thing about the global tariffs, right? We kind of upset the apple cart, the U.S. did, when President Trump took office, and he said he's really trying to make some generational changes in how we bargain, negotiate, and trade with other countries. And of course, his position is he's trying to do this for the benefit of the Americans and the American people and bring jobs back to the United States. We kind of spent 30 years selling our jobs off to the rest of the world, which eventually can come back to bite you. He's trying to kind of rectify that. Now, whether his way to do it's right or wrong is not the scope of this podcast. So forgive me, we're not going to do any political commentary.
Yeah, we just have to deal with reality, what's happening.
That's right.
Now.
And that's our job, right? Our job is to take a look very unemotionally at what's going on and then make some guesses, right, as to how it's going to affect our clients in retirement, because that's our lane, right? Our lane isn't to be a pundit politically one way or the other. So what's interesting, a lot of people, this question comes up quite a bit, Ron, is, well, who pays these tariffs anyway, right? Yeah. You hear the tariffs. The tariffs are actually paid by the person or company, right, that imports the goods.
Right.
Right. So if Home Depot is bringing in lumber from Canada, and there's a tariff, Home Depot is the one that has to pay the tariff, which makes sense, right, when you think about it, because the U.S. doesn't have the authority or the power to make another country give the money, right? But they do have the authority to make their taxpayers, right, pay more.
And so Home Depot either has to, absorb the cost or more likely pass them on to the consumers, right?
That's exactly right. And as of that, if you remember, the big news in the spring was President Trump called it Liberation Day, where he was going to do these mass changes and started to, and he's still in the middle of it, right? It makes sense that it wouldn't be something that you could do in one day, but many of them are getting resolved. But it was up to 19% on all imports at one time, and initially the markets took a tumble. And you had mentioned it in the opening paragraph, and I want to draw everyone's attention back to it. The reason it immediately tumbled is the reason most of the time the market tumbles. It's the word uncertainty.
Yeah.
Right? The markets do not like if something's new and they can't go back and look at past events and anticipate how it's going to play out. Now, it quickly recovered, didn't it?
Yeah, I was going to say markets have been really resilient, haven't they?
That's exactly right. And the reason is when something happens, whether it's tariffs or anything, if it's new and the outcome is uncertain, people panic. And usually when people panic, a flight to fear is flight to safety, which means you're going to see people pulling out of the market. And that can be a cascading thing. And that's why we saw in the spring the markets tumbled when this started. And as soon as people say, hey, look, the sky didn't fall, right? Or some of these other countries are starting to sign deals.
Yeah.
This isn't going to be as bad as we thought. All of a sudden the lights were going to go out, and they didn't go out. This happens all the time. It happened, if you remember, years ago with BRICS, Britain's exit from the EU.
Yeah.
I mean, everybody thought literally it was going to be the end of everything as we knew it. And then all of a sudden, like, hey, Britain's still there. And all of a sudden, things swing. So with the tariffs, they're still working through them. The market has proven to be very resilient as they've watched through and saw that, the sky wasn't falling. So far, these companies that have pay the imports, pay the tariffs, right? They have been able to absorb or pass some of it on to consumers, but it hasn't slowed consumer spending to this point, right? And the future will bear it out. But I think if I was talking to you as a client, Ron, I would say, look, this is like, it's always going to be something, isn't it?
Yeah.
Tariffs or threat of wars or active wars or famines so start thinking when you're trying to decide how much risk to take in your portfolios. What you really should start thinking about is this is the norm, that some event's going to pop up every 6 months that's the new, oh my gosh, this is it. And how are you going to respond to those?
Like Rosanna Dana used to say on Saturday Night Live, it's always something,
Oh, man, you're aging us. I know exactly what you're saying like it was yesterday. But any of you younger people listening, you might have to go to YouTube and pull up a Rosanna Dana. But yes, it's always going to be something, right?
Exactly. And the short term, markets have shown resilience, but the longer term impact it remains uncertain. And so I suppose that, a long time from now, you and I will still be talking about this to some degree.
That's right. Now, our bet, because a lot of people are saying, well, what's your bet? And remember, you get what you pay for. And this is true whether it's me or any pundit. But long term, based on what we've seen so far, there's still going to be some uncertainty. But on the long term, we expect this tariff thing to be good for the U.S. economy once it all pales out.
Okay, so I'm sorry, I didn't mean to interrupt. We're always talking about inflation and always concerned about inflation. And lately we've heard so much about the Federal Reserve and Jerome Powell and all of this kind of thing. Talk about how the Federal Reserve has a role in what happens with inflation and pretty much everything else.
Yeah, that's a great one. And this is so unique that the average person really doesn't know. They've heard the term Federal Reserve and they know it's an entity.
Yeah.
The Federal Reserve, the way it's set up now, they have kind of the autonomy to act and make decisions separate from the elected officials.
Right.
Right. And they hold kind of like the Supreme Court. Right. They want that autonomy so that they have the freedom to do what they think is in the best interest of their mandate. Right. And that's the key. Right. And their mandate is to try to control inflation. Right. And what's their other mandate? To control inflation and employment. Right.
Yeah.
That's the two things they're trying to do. So supposedly that's their sole focus is on those two things. Now, what you've seen here of late is that with the Fed is that they've had some missteps over the last several years. And whenever that happens, people lose faith in them, either that they're operating true to their mandates, that maybe they're being manipulated by the people in charge politically. But, when you start to lose the trust of the people, then you're ripe for attack, Does that make sense? Which is kind of what's happening now. If you remember back when the last administration was in and inflation spiked, which is their mandate, right? They were on the news saying, look, this is just, the economy's fine, it's just transitory. It was the famous verbiage, right?
Right.
And people are like, where does that come? What's the data to suggest that? And like, it's just because we're coming out of COVID, it's transitory, it'll go away. And of course, not only did it not go away, it continued to get worse and worse. Well, that's tough to come back from, right? Because you lose your credibility. You're better off saying, look, we're trying to figure this out too.
Yeah.
Right.
And now the Fed is facing a great deal of political pressure,
That's right. And part of it's a result of when you lose credibility, right? Yeah. Because you can't admit that, hey, these are uncertain. Then all of a sudden you open yourself up to this type of thing. So right now what's going on is that they're not lowering interest rates, which the president wants them to. And the reason is it's the same reason the last president wanted them to and every president before that. When you lower interest rates, the economy booms. Right? If you can borrow money cheaply, whether you're an individual, you can spend more. If you're a company, you can expand and hire more. It's really that simple, right? So if you're a president and an executive branch, and you want to look like things are going good under your watch, if you lower interest rates, everything takes off.
Yeah.
Okay, right. So what's happening now is it's getting a lot of press. Like there's a push. This goes on every administration. Right? Yeah. It's just being broadcast here that, this specific administration's pushing the Fed. Every administration does. The difference is sometimes they listen to the people in charge and sometimes they don't. Right?
Well, the Fed's, independence is really important for the future, I think, for stability. But, there are a lot of short-term pressures right now. So it'll be interesting to see exactly what happens. What about the U.S. dollar's reserve status? Tell us about that. What's happening?
Yeah, that one comes up quite a bit. So especially if you are on social media, because you know how everybody's in an echo chamber.
Yeah.
So if you start looking into that, then of course all you're going to get is feeds on that, right?
Yeah. Every time I open up my phone, I see all this stuff. So
yeah. So just a history, right? For probably 10 years now. Yeah. There's been articles that said, hey, because we're spending so much, because we're running up debt, we're going to lose the reserve, the dollar's going to lose the reserve status that it enjoys in the world. And all that means is after World War II, Ron, right, the world was a mess, right? And they said, okay, what we're going to do is we're going to, they wrote off a lot of debt. That's why a lot of times, in my opinion, we go to war. It's a way for governments to write off their debt, right? And then they can say, well, it wasn't because I was a bad leader. It was because of the war, right, that we have to wipe out the debt, right? Yeah. Think all the way back to the Civil War, right? If you had all your money was held in Confederate notes, sorry, right?
Yeah,
it was just the war. It wasn't that we ran things wrong. But so what happened was after World War II and the world was a mess, to try to get order, they said, hey, everyone's going to get together, we're going to figure this out, and we're going to decide on a world currency we can all agree on for trading purposes.
Right.
And to the victor goes the spoils. Since we had won everything primarily, everybody agreed to use the U.S. dollar. Well, that put us in this literally, Ron, Cinderella position, right, where you can run the world, because if everyone's forced to trade in your dollars, then if they print more, right, think Albania, if they print too much money and something's going on with their economy, then their money is worth less compared to the U.S. dollar. Does that make sense?
Right. Yes, it does. Okay. So the dominance of the dollar is pretty secure, you're saying, for the future?
Yeah, it is. And the reason is, this hopefully makes sense to most people. Now, it's justifiable that people want to drop the dollar, right? Because we're $37 trillion in debt. We are not being fiscally responsible. And they're worried that, hey, when you do make mistakes and do things, it affects us because our dollars are tied to your dollars. You see why other countries get so upset?
I certainly do. Yeah.
Right? But the question is, if not us, who? Right? So there's always this push has been, hey, we want to get rid of the U.S. dollar. In fact, for the last 5 to 10 years, I don't know when it started, the big one has been, have you heard the term BRICS?
Yes.
Okay, that's an organization of countries. It's Brazil, Russia, India, and China were the big four initially, when several others have joined. but they can't come to any agreement. And the reason they can't is because they all agree they want to go off the dollar. Guess what the next part of the conversation is? Well, then what do we use? And guess what China says? Use ours. But guess what Russia says? I don't like that idea. Let's use the ruble. And then guess what India says? Right? I don't like that. Right? So and add to that, as much of a mess as we're making of our economy with the spending and the printing money, they're all doing the same thing. It's not like everybody's fiscally responsible but us. All these other countries, they're in worse shape than we are.
Yeah.
Right? So one of the things I equate it to, it's hard on the podcast, but imagine I'm holding my arm up and I'm tilting it up. And as I tilt my arm up, remember the Titanic when it went down, if you saw the movie?
Yes.
Remember how it tipped up, Ron, before it sunk into the water?
Yeah.
And then all the people that were below deck were drowning. Remember that? And then everyone else was running. Where were they running?
They're running up.
They were running to the bow of the ship, the front. And the reason is they still knew the boat was going to sink, didn't they?
Yeah.
But but that doesn't. I just want to. That's the last place to go, right? I'm not going to say what the heck. Although some of them did. Remember the guys playing the music just kept playing the music. But the people who were running to the bow of the ship, to the tip top, to be the last to survive as long as possible. Yeah. Well, right now, what's going on, in my opinion, in the world is, since all this mismanagement and money printing and overspending, everybody's doing it, right? Yeah. So people go, well, how come the dollar hasn't lost so much value compared to what you're doing? It's because everybody's losing value. So relative to all these other countries, we're the same as you, but we're all sinking. We're just the bow of the ship. So when people get frightened, at the end of the day, they're going to say, look, I'm going to put my money in U.S. Treasuries because it's better than national debt from Albania or national debt from China. We have more hope that the U.S. Treasury note is more solid than these other ones.
So it's less bad than all the others.
Yeah, we're the last guy going under, right? Yeah. But so right now, I don't see a viable replacement to the currency crisis. I don't think that's going to change. Here's a great term I love using. We're what's called the less dirty shirt, Ron.
Well, that's a good way to put it. And I've got this vivid vision in my head now. You did such a great job of describing that using the Titanic and all that kind of thing. And I don't think I ever get that image out of my head. So thank you very much for that.
Yeah, there you go.
Well, change may eventually come, but the dollar right now is doing okay compared to all the others. What about all these geopolitical tensions and market reactions that are happening right now around the world?
So things like Iran, right? Yeah. The Iran strikes, the Israel-Palestine situation, Russia-Ukraine.
Yeah.
Ever heard the term, there's nothing new under the sun?
Yeah, I have.
Right, so again, the trick here is just like we talked about with the tariffs, take a step back. And what I would suggest is, this is the normal default way the world runs.
Yeah, there's always something.
It's always something going on around the world where I can't think of a time when there wasn't a conflict somewhere in the world.
Yeah. Right,
so events like the Iran strike or what's going on with Russia and Ukraine still, what you have seen now, I mean, can't even remember now. We're over 4 years into the Russia-Ukraine thing?
Yeah, a lot of
or
time.
more. But our markets have held up fine, right? So it's that same thing we talked about with the tariffs. You might see an initial dip because of uncertainty, right? But as soon as people get an inkling that, hey, the sky's not falling, the U.S. is going to be here, we're still going to be able to trade, you see a reaction. So people that panic usually lose big because they panic and get out, and then the market immediately recovers, and you're not in to recover. Now, you will see, depending on the conflict, right, you will see periods where certain parts of the economy become challenging. Like, for example, if they block the trading lanes for oil, right? Mm-hmm. Well, then oil's going to go up temporarily until they find a workaround. And the workaround would be, let's get a pipeline going to some place that doesn't need to use those shipping lanes, right? But there's resilience in the economy, the world economies, and barring some kind of a event where everybody's putting boots on the ground.
Yeah.
what we're seeing is long term, the world economies are going to continue to chug along, and the U.S. is in a good position to take advantage of that. So I would suggest to folks asking about these things, keep your focus, again, I'm sounding like a broken record, on your long-term financial planning, not short-term events and geopolitical noise. Just don't even look at it, right?
Well, that brings me to the thought that, Dave Lopez and the folks at ILG Financial want to turn all that noise, all that financial noise in your life into something much more palatable, and that's why we have the Retire Your Way podcast. The number to call if you'd like to get in touch with Dave and Chase and the folks at ILG, 540-720-5656. I wanted to get that in before we turn to the next topic here, the big, beautiful bill. That is the new legislation that is just passed. And again, we're not going to talk politics here, whether it's good or bad or whatever the case may be. But how is it going to affect us? This bill that is over 900 pages.
It's almost laughable, isn't it?
Yeah,
Well, let's just quickly talk about how it works. Starting with the 900-page bill. So I'll just hit a couple quick highlights, because I will start by saying this is not this. I'm not going to go into a deep dive here for time's sake, but we did do a YouTube short on it, on the big bill, Chase and I. So if you wanted to get a little more detail on this, if you just go to the YouTube site, and you'll see the one on the big beautiful bill. It's within the last month that we did it, and it gives a good breakdown of the things in the bill that affect specifically those in or near retirements.
Right.
So maybe only 800 of the 900 pages we cover on the YouTube. So here's a couple big ones to take away. First thing is there was some uncertainty on taxes because the current tax code that was put in place by President Trump under his first term, it had what's called a sunset clause, which means if no one took action, the Congress and the House of Representatives, if they didn't take the Senate, if they didn't take action, the tax rates set by President Trump in his first term would automatically go away, and the taxes would revert back to the higher rates that preceded them under the Obama bill. That date was set for December 31st of 2025. So as this date came, people are trying to do tax planning and not knowing if next year taxes were going to go up, right? Well, this bill put some clarity on that. They made the current tax codes, the original ones that President Trump put in place, they're permanent. And as we say in the YouTube, you'll get a kick out of this one, Ron, when we're talking about politics, permanent means temporarily permanent. Right. So all we mean is it's going to be harder now. They don't just go away. Now to change them, the Congress will have to vote to change them, and a president, whoever's in office, will have to stamp it, right? Which means because we're so polarized right now politically, that probably means the Democrats would have to have the House, the Senate, and the presidency to change the current tax code, probably. But just having clarity is good for the markets, right? Because people can plan. They can make long-term planning.
It's permanent for now.
Temporarily permanent. We love that term. So on the short term, it's a boost for investors, right? Whenever you get some positive news, which is positive because these rates are historically low. Now, is that good for the country? That's not this podcast, right?
Yeah.
For the debt and the macroeconomics, my concern is how does it affect our clients, right? And the folks listening. And it's very good for you because you are currently in historically low tax rates. And our guess is because this is made permanent, we probably have another 4 years and maybe more of these rates to take advantage of if you want to do things like Roth conversions or anything else that's tax efficient where you think I would like to pay the tax now under these historically low rates and try to not have so much money exposed to tax liability in the future when their taxes are going to be unknown, because there's still a problem with $37 trillion in national debt and rising. And this bill on a macro level, this is what I mean by this isn't my lane. It doesn't affect the clients right now. But the downside to this bill is, in addition, right now we're adding close to $2 trillion a year to the national debt, which is currently over 37 as of the podcast we're doing. Now we're adding about $2 trillion, but this change is anticipated to add another 2 to 3 trillion, not a year, just over, the next 10 years, but that's on top of the 2 trillion a year we're running up in debt. Yeah. So it's sooner or later, taxes, in our opinion, are going to have to go up and go up considerably, because you can't print money forever without repercussions.
Yeah, and I know there's so much in this bill that we don't have time to go into all of it, and certainly, so much of this conversation is political, and we don't go there on that. But so again, I'll just remind you to visit the YouTube channel and watch that video, and you'll learn a lot from that. I plan to do exactly that, Dave. I'm going to do that myself when we finish up with this conversation. Another thing I wanted to ask you about is artificial intelligence. We hear so much about AI every single day. How is that affecting the economy?
Well, it depends on how old you are, if you can relate to this, but this is about as similar a scenario as I could draw to you with what's happening with AI now. If you were an adult back at the turn of the century, this is what happened with the dot-com boom and the dot-com bust.
Yeah, that's a good point.
I mean, the internet had exploded. No one knew what it meant. We just meant the world was, for the rest of our lives, was going to be different somehow. And now we look back 25 years later, and boy, was it, right? If you look at where we were, what you could do in 1995 and what you could do in 2025 because of the internet, right, is incredible, right? But it caused initially a huge boom. It was the boom of the 90s and this anticipation of this new world. And then in 2001, 2002, we had the dot-com burst. You're going to probably see this play out in a similar fashion. And what I mean by that, there's some companies that are huge winners already and will continue to be. We just don't know which ones they're going to be. Does that make sense?
Yeah. And there are a whole lot of companies out there rely on AI or specializing in AI.
That's right. And the future, we still have no idea how beneficial that will be for the everyday brick and mortar company, right? How much AI will change their bottom line, lower their costs, and how it will affect employment. So that's going to all play out kind of just like the dot-com thing did. If you're betting on AI by buying individual companies, I would just say beware. The example I give is, how many times have you ever met someone, Ron, that said, boy, if I just bought Apple in 1999, right?
True.
Right. Well, what people don't realize, if you were around in that period, is as this dot-com bubble exploded, there were hundreds of startup companies that were going to rule the internet. That's and right. Almost all of them are gone. A few came out on top. And yes, if you had been able to pick the Apples, right, and the Hewlett-Packards at the time, right, and the Microsofts, then yeah, you hit it gold. But what if you had picked, remember Tandy was an offshoot of Radio Shack?
Yes, I do.
Right? They were right up there as far as innovation with gaming and all that stuff, and they went bust. So what you will see in any new industry that's a game changer is, in the beginning, it's the Wild West, and everyone's going to jump into the game. And when you look back 10 or 15 years later, there will be a couple winners. There'll be a couple benefited from the rise, but they weren't huge winners, right? But they turned into solid companies. And there will be a lot of companies that nothing happened. Yeah. A lot of people don't know this, but back in the day, if you go back, there were companies that had nothing to do with the internet, Ron. And their company stock was struggling, and all they did was change the name of their company to, I'm going to give you a hypothetical example, ABC Trucking, and they switched it to abctrucking.com, and their stock went through the roof.
Wow.
They didn't change anything,
and
right?
Thought about that.
People said, "Oh, it's the internet." It's right. You jumped in. So kind of like today, you hear about these meme stocks. Right, so that happens when you have a new industry. It's happening with AI now. That's why you hear it so much. Everybody's throwing the word around, whether you're creating AI or whether you're a company saying you're taking advantage of it. Time will tell how it benefits. Some industries will do really benefit. Others will be very little, right? But in the long run, we promote strongly, continue to broadly diversify.
Yeah.
And if you want to make us...
That's really one of the most important points that we ever talk about. Diversification is so important when it comes to your financial plan. You got to make sure you're diversified.
Yeah, if you get in this habit of chasing winners, What usually happens is you are the last guy into the party, right? Because you've watched them become a winner. So now you jump in, and next thing you know, some other upstart company comes up with a new battery or a new chip.
Yeah.
And all of a sudden, your company doesn't grow for the next 5 years while this other company goes up 5 times. So it's kind of like a cat chasing your tail. If you're trying to chase winners, it's just too hard to pick the winner. Yeah. So if you had just diversified and said, okay, if I really think this industry as a whole is going to take off, let me buy a broad diversification across several industries that it now looks like will benefit from AI, and then I'll have growth regardless. Right? But I'm not going to hit the one that goes up 100 times like Apple back in the day, right?
Right.
But I'm also not going to go bankrupt because I picked the one that was in business for 1 year, and then you turned out that they didn't even have a product.
Yeah, it's, all these folks out here with all these hustlers and folks, get rich quick schemes. It's best not to go with that. It's best to go with a solid plan that is diversified all over the place. It
is, and I would say AI moving forward, I do believe it's going to be long term is the key here, a positive force, just like I think the internet was a positive force. I don't know of anybody who would say, look, we've got problems with malware and phishing and all of this, so I wish we just got rid of it, right?
Yeah.
Because there's bad and good. That's true of every new industry.
Exactly.
Right? But usually when you hold people's feet to the fire, they're like, you know what, as lousy as all this spyware and malware and all of this is, I wouldn't give it up for the conveniences and benefits that I also get. Okay. That was true when .com happened. That's going to be true with AI. You can go back 5,000 years of innovations, right? People would say, look, I wouldn't give up what we had when Ford invented the assembly line, right? Because even though there's some negatives to it, but in the end, it was game-changing. There's winners and there's losers. This is no different.
Well, it's so important to have a financial plan and to ensure that you have diversification in your portfolio. And there are several core principles involved with a plan, and the folks at ILG Financial can help you put that together.
Yeah, all the stuff we talked about, all the top topics today, tariffs, inflation, debt we talked about, deficit, AI, geopolitical events. If the one key takeaway, if there's anything you took away from the podcast, it would be you need a disciplined financial plan. Discipline means you're not changing it every 2 weeks because of something you read in the paper, right? A well thought out plan. I strongly recommend folks to get with a financial advisor so that you have if nothing else, a sounding board, right? Someone who's built more than one plan. This is your first plan, right? Chase and I, we're over 15 years of building plans. Right, hundreds of retirements we've gone through, and other advisors are the same, right? You want to find someone who's done hundreds of plans, and that's a good coach, a good sounding board to build a disciplined financial plan that can weather these type of things because they're not new, right? AI's new, but a disruptive new innovation that to the economy is nothing new, right? So you want to build a plan that ensures it aligns with your goals and specifically with your risk tolerances. And what I mean by that, Ron, is you want to be able to work with your advisor, and we do this with all of our clients, and say, listen, let's assume a 2008 type of a crash. What would we expect your portfolio to do based on how it's invested if that happened? And we actually have software that can model that, which is kind of neat, right? And the idea is not that we can somehow magically avoid risk. We can't. If you're going to take risk, we can't time the market. But what we want to do is build out a portfolio that performs, ideally, the way you and your advisor expect it to perform based on what's going on in the world. That way gives you the confidence to stick with the plan. And you do that with these core principles: diversification across asset classes, right? And don't just put 10% in everything. There's a specific way to decide how much. And it's just using computing power and data over the last 80 or 90 years to try to get the ideal match. Tax efficiency, right? You can get a good rate of return, but if you are not taking taxes into account, it's all for naught if you're losing it, right? You want to annually, at a minimum, be reviewing your plan to make updates based on changes in your life, or changes that you and your advisor think are going on in the world, changes in taxes, you have to continue to tweak the plan. It should be a living document. And finally, working with an advisor, the advantage, Ron, is by having a sounding board, it helps you resist making emotional reactions to headlines and market swings. That's where folks most losses occur because of knee-jerk reactions. It causes them to make a loss one time, and it may take you years to make up for that one mistake. And the way around that is to have a diversified, disciplined plan that's thought out, where you have discussed with somebody in advance how you're going to act when a certain economic event happens, like a major market correction.
Well, all these things you're talking about, this a good financial plan developed by the folks at ILG Financial and you working together, can sometimes be boring. It's like brushing your teeth. It's not really exciting necessarily, but it will get the job done.
Yeah, it is. It's boring. My kids tell me that all the time, but we're really happy with boring, right? I'm happy with the market things changing and our clients saying, hey, this is what we talked about last year. We thought this would happen, right? That is music to our ears, and that's what you should want with your investments. Predictable outcomes, right, that you have already thought through and you're willing to live with to get where you want.
Yeah, and the key is to have long-term financial health, and you're able to respond to what happens because not only do you have a plan, but working with ILG, you are able to tweak it along the way to suit whatever is going on, and making sure that you are prepared for the future and to have the kind of lifestyle and retirement that you've always wanted. Dave, this has been a really fascinating conversation. I appreciate your taking the time to explain all these things to us.
Oh, yeah, I enjoy it. I love talking about it. I appreciate you doing it with us. I enjoy our back and forths.
You've been listening to the Retire Your Way podcast with Dave Lopez of ILG Financial. Dave happens to be the founder. He and Chase Lopez work together, of course. And if you'd like to find out more, you can go to ilgfinancial.com. That is ilgfinancial.com. Income, legacy, growth, it's all right here at ILG Financial. It's about helping you plan for retirement your way so you can achieve your financial goals. You can call ILG Financial at 540-720-5656 or go online to ilgfinancial.com. This has been the Retire Your Way podcast. I'm Ron Stutz with Dave Lopez. Thank you so much for listening. The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and do not necessarily represent the views of the Alpha Star Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through Alpha Star Capital Management, LLC, a registered investment advisor. Alpha Star and ILG Financial, LLC are independent entities. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability.
Hey, Chase Lopez here. Thanks for listening to Retire Your Way with ILG Financial, our podcast. Make sure you head to our YouTube channel as well to check out our video series, Retire Your Way with ILG Financial. Also, don't forget to subscribe and like our videos there so you can be alerted for any future videos. Talk to you soon.